President Trump's planned May 2026 visit to Beijing is intended to reduce tensions between the United States and China over trade. But for the U.S. accounting profession, especially large international accounting and auditing firms, the visit is unlikely to bring a return to normal business conditions. Instead, it signals continued complexity and regulatory pressure and higher compliance risks. One big issue is China's stricter control over financial data and cross-border information sharing. Accounting firms may face problems transferring audit records, financial documents, and company data outside China. Chinese regulators are also increasing scrutinies over inconsistencies between local tax filings, bank records, and global financial reports. As a result, accountants must ensure extremely accurate reporting across different accounting standards such as US GAAP and IFRS. Auditing multinational companies operating in China is also becoming more complicated. The U.S. government continues encouraging companies to reduce dependence on Chinese suppliers as part of the broader de-risking strategy. At the same time, China has introduced policies that may penalize foreign businesses for moving supply chains away from the country. This creates a difficult environment for accountants and auditors who must navigate conflicting regulations and increased reporting risks. Political uncertainty, tariffs, export restrictions, and supply chain disruptions are also affecting the company valuations. Businesses with significant Chinese operations may need to reassess the value of assets, investments, and goodwill. Accountants will play a key role in conducting impairment analysis and evaluating financial risks connected to ongoing trade tensions. The 2026 discussions are also expected to focus heavily on artificial intelligence, semiconductor technology, and managed trade agreements. Proposed systems for monitoring trade commitments could require companies to develop new reporting and compliance procedures. Accounting firms will increasingly advise businesses on AI-related regulations, technology reporting standards, and financial disclosures tied to emerging technologies. Another unresolved issue involves oversight by the PCAOB, or the Public Company Accounting Oversight Board. American regulators continue seeking access to audit records of Chinese companies listed in the United States, but China usually treats certain financial records as a matter of national security, creating ongoing uncertainty over audit transparencies and regulatory cooperations. At the same time, stricter enforcement by Chinese authorities is increasing demand for forensic accounting, compliance consulting, and transfer pricing expertise. Multinational corporations are expected to strengthen internal controls and provide greater jurisdictions of how profits and costs are allocated across international operations. Overall, Trump's 2026 visit is less about fully resolving U.S.-China tensions and more about managing them. For accountants, this means operating in an environment of controlled instability, where international business continues, but under greater scrutiny, higher compliance expectations, and persistent regulatory conflict between the two very different systems.